Hey everyone, in this video I'm going to evaluate a growth stock that has 70% upside according to Wall Street. Their range of estimates according to 22 analysts that Yahoo Finance surveyed. Average price target is $15.95. Currently this stock is trading at $9.41. Surprisingly, there is a significant range between the low and the high of this stock. At a high, one analyst thinks it should be worth more than twice where it's at today. This analyst thinks it should be at $22 per share. One analyst thinks it should be half the price it is at today at $4.50. So you've got a wide difference of opinions on this growth stock. So this video I'm going to evaluate this stock, and then I'll also give my opinion on where I stand, where I think uh, the value should be, which part of the range I'm at. So let's begin. So the stock in question is Peloton. Peloton. Um, the company thrived during the pandemic and even before. I mean, revenue grew over 200% for one quarter during the pandemic. But if I was to pull up, there was a chart that the company used to share. I don't think it shares this anymore, but it showed its revenue growth 4 to 6 years leading up to 2020. And the company had grown revenue by 100% every year, even before the outbreak. So this was a company that was growing, doubling every year. Strong consumer demand. Its customers loved the product. So it was thriving. And then pandemic, demand soars even higher, and then management overreacts, right? Management says, "Oh my God, we have the best company in the world. Everybody loves our products. Let's invest in increasing our capacity. Let's buy a manufacturing company for $400 million. But before that, we even digest that acquisition. Let's invest $400 million and create our own manufacturing facility on top of the $400 million we already spent to buy a manufacturing company. Let's expand overseas. Let's add new products. Let's add new geographies. Let's add new languages. Let's do all of that all at once without letting each one of these things come in and see how it plays out." And now we know how that turned out. Consumer demand absolutely crashed as soon as the economy started reopening. Revenue crashed, and now you have the company in negative revenue mode for 4 or 5 consecutive quarters now, with revenue at negative 30% in its most recent quarter. So all of that overinvestment combined with falling revenue has led to a terrible scenario with its operating profit margins. So if you ignored everything after this midpoint of 2021, I mean, this was looking to be a great company. It had revenue growing over 100% every year for 6 or 7 straight years. It had operating profit margins expanding, right? If you've been with me, you know I talk about this. The trend was moving higher with operating profit margins soaring in response to higher revenues. Everything looked great. And then you had that terrible decision by management to overinvest. And then you had this collapse here. And now you have negative 43.43% in operating profit margin. So for this, Peloton should be a case study in um, monitoring big decisions by management and making changes to your thesis in your willingness to invest based on these changes. I'll give you one example in Shopify. Shopify was another company that looked like this, that looked like Peloton, until management made the decision to invest billions of dollars in fulfillment and logistics. And I said, you know what? No, thank you. I got myself out of that investment as soon as I saw that decision. And what I'm seeing now from Shopify is similar to here, where its operating profit margins are now falling. Now, in the longer run, it may turn out to be a turnaround, but for now, it doesn't look good. And that's an example of what Peloton went through as well. A company that was doing really well, and then a big decision by management that changed the course of their long-term business. Because now that old CEO had to retire. Oh, I shouldn't say old. The previous CEO resigned, and the new CEO is now having to fix the problems, divesting some businesses, lowering costs, making a bunch of changes to try and improve the business. So along with falling profit margins, we have collapsing cash flow from operations. The good news here is that this looks like it's turning around. This looks like the CEO has made some good moves. I do agree with a lot of the moves this new CEO has made. For one, he slowed down production of new exercise equipment because they've got a lot of inventory, and I'll show you that. But he just said, hey, we don't need to be making more product. We've got enough product. We need to focus on selling this product. And he worked to de-risk the business, moving more towards a variable expense structure versus a fixed expense structure. And the variable expense structure works better when you've got falling sales, because when your sales fall, your expenses also fall. So I'm liking the moves by the new CEO, and there is early evidence that it is working. And here I'll show you what I meant with the inventories. Look at how inventories soared all the way up to 1.5 billion in early 2022. Remember, in the early stages of the pandemic, Peloton had so much consumer demand that people had to wait 10 weeks to receive their bikes and their treadmills. They were, backed up. And now they've got way too much inventory on their hands. So now they've, kind of stopped production. They now only have 790 million in inventory. And that's crucial because their cash balance really fell to dangerously low levels. They had to do some emergency financing to get their cash back up. And now that they've sold some of their inventory, their cash level is stabilizing. But when you're burning through this much cash and losing this much money, you're not in a safe position. So, new CEO making the right moves. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And then finally, valuation. The stock is trading at a forward price to sales of 1.1. This is, 90% lower than where it was trading at. It was once trading at a forward price to sales over 12. And in this valuation over 12, in my opinion, was justified because the company was just everything was moving in the right direction. It had a great business model. Everything was working great until that's the previous CEO and the management team made that huge blunder of just going all out with that overinvestment. If they hadn't done that, the business would be in great shape today. Sure, sales would have declined, but the business would have been in a position to absorb that decline in sales without, putting it at risk of running out of money. They would have just said, all right, gyms reopened, sales slowed down. That we that's understandable. We can just wait for this trend to kind of slow down, and then we can re-accelerate. We can add new markets. We can find new growth avenues once the economy finds its equilibrium coming out of the pandemic. Instead, that overinvestment put the company in a position where it couldn't absorb the decline in sales. It caused a huge crash in profits, in cash flow, and it caused a major disaster. So, as promised, I will tell you that I am on the lower end of this valuation. I'm not on the higher end where I think the stock is a strong buy. I'm more on the lower end of this valuation, where I think that this stock is very high risk, but potentially very high reward if this new CEO can get things right. And so far, the new CEO is getting things right. And it's early days, right? Hasn't had much time, but in the time this new CEO has had, I think the decisions have been sound. So I can understand that Wall Street um, thinks this stock has 70% upside from here. It wouldn't take very many positive steps to get this stock turned around and moving higher. All right, so that's all I've got for this video. Thank you so much for watching. I really appreciate your viewership.